Hi everybody, welcome back to the 10th of an Hour with Griffin Bridgers. For today's episode 119, we're going to look at some of the basics of inherited IRAs. Now we're going to approach this subject not necessarily through the lens of what has changed with the Secure Act, but more what would happen if you had no knowledge of inherited IRAs and you're taking a fresh look at the laws as apply today. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So what is an inherited IRA? Generally, an inherited IRA is going to be any IRA that's acquired by or payable to a beneficiary as a result of the death of another individual. Now, that other individual could have been the original IRA owner, or they could have been a beneficiary of an inherited IRA themselves, but either way, the inherited IRA has to be generated by the death of somebody further up the ownership stream. Now, there's three main ways in which an inherited IRA differs from a traditional IRA or qualified retirement plan. For one, the required beginning date for the inherited IRA is not typically dependent on the age of the beneficiary, except in the case of a spouse, as we're going to see. Two, there's no penalty tax for early distributions prior to age 59 and a half. And three, no rollovers can be made from an inherited IRA to your own IRA or qualified retirement plan other than with respect to a spouse who is a beneficiary. So, as with respect to the required beginning date, that changed with the Secure Act, but generally if you own an IRA that's a traditional IRA, you have to start taking distributions over your life expectancy by April 1 of the year following the calendar year in which your 72nd birthday falls. So once you reach age 72, go to the following year, and by April 1 of that year, you're going to have to start taking required minimum distributions. And also, if you take distributions prior to reaching age 59 and a half, in addition to the ordinary income tax on those, you're going to have an additional 10% penalty tax unless there's an exception. Now, there's a number of exceptions allowing for early IRA distributions without penalties, such as a first home purchase, medical expenses, educational expenses, hardship distributions, or even substantially equal distributions over life. Now, in the case of an inherited IRA, these required beginning date rules don't apply. Regardless of the age of the beneficiary, instead what happens is that in the year of the death of the owner of the IRA, any required distribution must be taken. That would include the previous beneficiary as well. And then finally, any distributions that are going to be calculated based on the life expectancy of the beneficiary must commence the following year, the year after the year of the owner of previous beneficiary's death. And the first such distribution will be payable by December 31 of that year. After the Secure Act passage, there's some different permutations that apply as to what the distribution requirements are for an inherited IRA. First off, if the beneficiary is an eligible designated beneficiary, then the beneficiary can choose to take distributions over their life expectancy. So, eligible designated beneficiaries are going to be individuals such as a disabled or chronically ill individual, or trust for the sole benefit of one of those individuals, or a child under the age of majority, which is undefined right now. It could be anywhere from age 18 to 26, or for a spouse, or for an individual who's older than the account owner or beneficiary was. And these life expectancy distributions, as I mentioned, must commence by December 31 of the year following the year of death of the account owner. Now, for any other individual or any other trust that meets the traditional definition of designated beneficiary, you can no longer get life expectancy distributions. Instead, there's a 10-year rule that applies where there's no periodic distributions that are required, but the entire IRA has to be distributed by the later of December 31 of the year containing the 10th anniversary of the owner's death, or, if later, the 10th anniversary of a beneficiary child's attainment of the age of majority, or, if later, the 10th anniversary of the death of an eligible designated beneficiary. Now, when it comes to a spouse who's the beneficiary of an IRA, the spouse has a choice. They can choose to roll any distribution over into their own non-inherited IRA within 60 days of the distribution, or they can choose to keep funds in an inherited IRA. Now, this only applies to distributions in excess of the required distribution. So if the spouse is required to take a distribution with respect to the deceased owner's life expectancy or their own life expectancy, that amount could not be rolled over. Now, the difference is that for a spousal rollover IRA, the required beginning date is based on the spouse's age, whereas for a spousal inherited IRA, the required beginning date is based on the deceased owner's age. Now, that rolls into the first bullet point because typically your deadline for a spousal rollover is going to be the later of 60 days after receiving a distribution, or if you haven't distributed anything, you have the option to make that rollover anytime prior to the required beginning date of your deceased spouse. Now, trust and entity considerations continue to be an issue because we still have a 5-year rule that could potentially apply. Now, we'll talk about this in another discussion because largely the look-through rules for trusts still apply after the Secure Act, but they apply more for purposes of distinguishing between lifetime distributions to an eligible designated beneficiary or simply 10-year rule distributions to just a designated beneficiary, or the 5-year rule for an entity. So here's how the 5-year rule still applies and how these rules apply holistically. So you still can break down the requirements based on whether the owner has reached the required beginning date. So if there's no eligible designated beneficiary or even designated beneficiary, then you still look to the required beginning date. And in that case, you're going to have a 5-year rule that applies, or if the owner had reached the required beginning date, you can use their remaining life expectancy, and you have to, even if it's shorter than 5 years. So it's possible you could become in a worse place than you would with the 5-year rule. Now, in the case of just a designated beneficiary, there's a 10-year rule that applies across the board, regardless of whether the owner has reached the required beginning date. But in the case of an eligible designated beneficiary, you get to use the longer of the owner's life expectancy or the eligible designated beneficiary's remaining life expectancy. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.